Your market news now. Asian stocks rose as traders figured a small upside surprise for U.S. inflation was unlikely to push up interest rates, while the euro was firm, leading into a European Central Bank meeting where expectations leaned towards a rate hike. Meanwhile, yesterday's U.S. data showed higher fuel prices had lifted headline U.S. consumer prices by the most in 14 months in August for an annual rate of 3.7%, which was a touch above expectations. Core inflation slowed to an annual 4.3% as expected, and locally FirstRand posted an 11% rise in annual profit as the bank benefited from rising interest rates even as its bad loans rose. To give us more perspective, particularly from a fixed income point of view, we are joined by Reza Ismail, who is the head of bonds at Prescient. Reza, thank you so much for your time. Let's start off from the onset talking about that US CPI figure. Do you get a sense that the trend is moving in the right direction?
Thanks very much. Very happy to be part of your show. Yes, definitely the trend is moving in the correct direction. I mean, as you would have seen, yesterday, largely being driven, the headline figure largely being driven by energy determinants. And we think that the disinflation process is certainly getting traction. If we look at core and consumption-based measures of inflation, then you will see that the only thing that is preventing inflation from registering even lower values is a shelter component. And basically that almost out of mathematical necessity will also retrace downwards in the months to come. So definitely heading in the correct direction.
What's your assessment of bond market activity recently and some of the factors that are driving that?
Well, I think what's actually been happening in the South African bond market is something akin to a bit of a very insular and closed loop system. And what I mean by that is it's essentially bonds being moved around from local participant to other local participants in the sense of an asset manager to another one, or between a dealer bank and an asset manager. And why I'm saying this is because what's been almost conspicuously absent has been the foreign activity in the South African bond market, right? So you have that, and the reasons for that is not hard to see. You have very high sort of risk-free front-end rates in places like the US, and it just makes the opportunity cost of global capital leaving places like the US and sort of finding a home in South Africa all that more challenging. So what you find is that foreigners normally had a footprint in the South African bond market of around 40%. That has dwindled down to now around about 25%. So I think the South African bond market will be a very different place when foreigners start participating in our very, very high real yields once again.
On that note, then, how do SA bonds compare in the emerging market space?
I think in terms of the real yields, which I alluded to, I think we almost at the very, very top of that list. South Africa, whilst commonly grouped with emerging market cohorts, what we actually do find is that it's got a lot of very, very pleasing attributes that actually make it stand out somewhat, when you look at it in terms of its emerging market cohort. What I mean by that is that South Africa has actually got a very, very small stockpile of hard currency or foreign denominated debt. That's a very big positive. In terms of the actual maturities of its existing rand bonds, that tend to be quite far out, so longer dated maturities. And then the third one, and perhaps the most consequential one, is that we've got a very credible central bank that has got a very long and demonstrated history of being able to keep inflation in kilter. It's almost been, sort of 20 years of inflation targeting by the South African Reserve Bank, and they've done a stellar job. So you take a very, very stable and very, very credible Reserve Bank. You take the issue of having most of its debt being denominated in rands. This is quite somewhat atypical, and a very, very small stockpile of foreign denominated debt make it quite an attractive emerging market location when sort of risk on mood does take hold of global capital.
Let's move things stateside for a bit. When you look at the Fed, what do you believe to be the biggest risk factor for them right now?
Yeah, so I think that, when looking at the risks which the Fed faces, I think that there are those proponents who effectively want to say that the risks to the Fed actions is almost like symmetrical around two alternatives. What are they? The first one is that the Fed almost over-tightens, right? In other words, they create a policy environment that is perhaps too restrictive and too hawkish in the face of a disinflationary process that is already happening and gaining quite a good momentum. In other words, the policy rates are simply too high, and the heavy lifting in terms of getting the disinflation process going will necessarily come from a rehabilitation of the supply side, which is already happening. So there's one argument to say that policy rates are almost unnecessarily tight, and the risk is that the Fed almost over-tightens. In contradistinction to that, there's another camp that believes that perhaps any talk of the Fed perhaps taking their feet off the pedal somewhat is premature, and there is then the risk that, for example, you do find consumption-based measures of inflation sort of re-emerging, right? Somewhere down the line. Now, in terms of these two opposing views, we would much rather say that the data supports the view that we certainly do think that the risk is much more tilted to the former of these alternatives, i.e., that the Fed in fact over-tightens in the face of a disinflationary trend that is already happening, right, and is already being driven by, as I say, a rehabilitated supply side.
Reza, I would have loved to ask you about where you're seeing opportunities and where you're underweight, but I want to leave that conversation for next time. Going into the SAB meeting next week, what are you expecting?
Well, I think that basically in terms of inflation having almost come in significantly below expectations, I mean, at the last print, the market or consensus expectation was looking for 4.9%. They came in at 4.7%. So making its way gradually towards the midpoint of that range, I think there's plenty of evidence for the SARB to basically keep rates on hold. And I'd be very surprised if, again, they resumed, any sort of hiking activity. And the communication around a hold, which we think is very, very likely, would largely take the form of them saying that, sort of food, fuel, and electricity prices have trended in the right direction, slight uptick in fuel again. But I think that there's plenty of evidence and plenty of fodder for them effectively to keep rates on hold from here on.
All right, Reza, thank you so much for your time. That is Reza Ismail, who is the head of bonds at Prescient, giving us his perspective on bond market activity. We're going to take a quick break. When we come back, we'll have more news for you, so stay tuned.